Welcome to Microfinance Podcast, bringing microfinance to your screen. This episode is produced by MicroSave, together with ShoreBank Exchange. Hello, my name is Oksana Holtman and welcome to another edition of Microfinance Podcast. Today we are talking about delinquent loans. What does one do once a delinquent borrower is identified? In this episode, Dick Turner will share with us his observations on the psychological aspects of managing problem loans and treating them as a learning experience.
Once you're certain, beyond a doubt, that the loan is a problem, you're probably too late. It's probably too late now. You didn't react fast enough. You didn't look for those payment trends, those collection trends. Once you are sure beyond any doubt that the loan is a problem, well, you're probably going to lose money, frankly. I hate to have to put it so starkly, but that's been my experience. You have to try and identify problem loans the best you can before they become full-fledged problems. And the best way to do that is to take the time to make the monitoring visits. When a small or even a medium-sized enterprise is in trouble, those management weaknesses will almost always get worse. If the management weakness from your borrower was that she didn't like to deal with detail, including collecting accounts receivable, and really didn't pay attention very much because she didn't feel comfortable with the mathematical parts of the business, if the business is starting to be in trouble, it's probably worse than you think because she isn't paying attention to the gross margin, which has slipped 10 points, to the collection of receivables, which have gone from 45 days to 90. She may be in a cash flow negative situation and doesn't even know it. If that happens, you have very little time to act. You have maybe 30 days at the most. Never, ever assume when a company's become a problem loan that the gross margin will get better. Because I, frankly, have never seen it happen. I could call to mind, their faces are in my mind right now, the borrowers of mine who became problem loans who said, Richard, don't worry, sales will get better. That's the first thing they'd say. If that didn't seem to convince me, the second thing many of them, not all of them, said was, I can improve my profit margins. I promise you I can. You'll see. I know the profit margin's been disappointing. It's been 42% when I projected 58, but I'll get it up to 50, and then within 6 months, I'll get it to 58. It won't happen. It won't happen. Not if it's in a problem loan situation. Another unpleasant observation. In a problem loan situation or when the business is having trouble, I don't know why, it's almost mystical, but costs have a way of increasing. Sometimes I think this will sound foolish, perhaps, but sometimes I think that when a business is having trouble, small business people want company. Who doesn't like to share misery with another human being, right? So perhaps they hire more people so they have more people to commiserate with. I don't know, but I can tell you, I could give you scores of examples where costs, not necessarily costs of production, but sometimes costs of production, but what we call selling, general, and administrative costs increased, sometimes even as sales were decreasing. If the sales decrease was the first thing that went wrong and made this a problem loan, somehow these costs edging up in the face of revenue going down really contributed to it and put the company in a bad position. Never underestimate, there I go with that word never again, I know, but never underestimate the havoc, the terrible problems that problems create. You know, your borrower knew before you did that the company was entering a time of troubles. She knew before you classified this as a problem loan that her company had become a problem. People feel ashamed of this. They feel guilty about it. They feel like they've failed. And for small business people particularly, this is their life. This is their identity. Being in business, having this company, This is their identity, much more than having your job as a lender is for you. Some of us were deeply proud of our banks and our lending jobs. We felt like we did a lot of good, and maybe we do, but it's still a job for which we receive a salary. When you're a small business person, it's different. This is your soul, this is your life, and when you know you're failing, even though you may not think you're ultimately going to fail, when you're failing and things aren't going well, you take it personally and you feel ashamed. Finally, I told you never to submit a loan request without having computed the break-even point. When you go out on those monitoring visits, compute the break-even point then too. And if the loans become a problem loan, I will bet you money that the break-even point has become worse. Finally, for every hour you spent analyzing a loan request, however many hours it took, 4, 8, 12, I'm sorry to give you the bad news, because it is bad news. For every hour you spent underwriting and analyzing and then approving this loan, now that it's gotten to be a problem, you will spend 5 to 7 hours working it out, as we say, or trying to deal with it. Factor that into your workload. Problem loans are extraordinarily expensive for a financial institution.